Hi, today's topic is how to value all assets in real time. Every business owner, manager or professional should study this. You can know what revenue streams create value and which ones don't, and why and when they create value, and what management decisions should be taken. In fact, you can determine your own investment strategies if you have prior industry knowledge. According to the Inland Revenue versus Muller case in the House of Lords in 1901, Lord McNaughton said that goodwill value must emanate from a source and described it as the attractive force that brings in custom. Today, I believe we can solve this mystery as to the source of goodwill value when no one else has been able to do so in the last 118 years. Not even the latest High Court decision here in Australia. Every valuation must be based on the law, but most are not. The source of goodwill comes from sales or services. There is nothing else. Sales are the market proof that what is on offer is acceptable to the market. There is no value created until a sale results. Then you must be able to profile and benchmark turnover in order to value it. Sales and services are the only items that create value. You cannot create value by rearranging expenses and deleting the ones you think are less important. So the greatest and most powerful item to watch is sales. It is the only number that creates value, and if you are in business or a business that does not create value via sales, then all you need is a separate investment strategy to create growth. You have already have the most powerful item in the world, namely cash flow. Only 10% will ever go into business, and only 5% of them know how to create turnover or sales. Creating sales in the marketplace is the hardest endeavour of all time, but once created, it has value. You can watch and see all performance occurring between you and the market environment. You can see the history, the performance, and the value you are creating all on one page. There is no other figure that is more provable, dependable, and reliable than sales. Owners and managers can react in real time to adjust any adverse movements and correct issues if they present themselves. Profiling allows you to identify risk areas such as source, age, location, size, payment duration, productivity, and key personnel, commonly called KPIs, and each entity should predetermine the KPIs most applicable to their risk areas and keep a sharp eye on those numbers on a highly regular basis. And it will allow you to form the greatest assessment required in business valuation, and that is the classification of goodwill sales, namely turnover. Are they locational, personal, transferable, or combinational? Without this, you cannot possibly value a business reliable. So the only number that creates value is sales or services in the marketplace. You can have the greatest idea in the world, but if you cannot sell it and sell it with margin, you have nothing. Anyone in business or investment mode can know and interpret the value of revenue streams, both as to the value they make and understand the impact of ownership or management styles. No two people will ever run or manage a company in the same way, nor will they use their assets to their full potential. Profiling. This graph on your screen represents an average management practice, whereas the next valuation graph may represent above average management, and the value of goodwill may or should be higher due to the margins or the prevention of declining sales. Qualitative numbers have absolutely nothing to do with markets. They are subjective and are the opinion of one person. Banks swallow this information, so do solicitors and judges. However, I am stunned that the High Court justices in the case of Placerdome Inc. in December 2018 were able to embrace revelation or higher knowledge that allowed them to comprehend and perceive the fallacy of the arguments put forward by the accounting methods in that case, which were rejected on the basis of unreliability. Only profiling can identify revenue source, such as related party activity or key personnel. And you must know where revenue comes from to be able to value it. Then we move on to benchmarking. Benchmarking can also be plotted in relationship to sales, which will enable you to understand exactly where you trade within an industry. You should know where you sit as far as productivity is concerned, staffing numbers, and without this information, you are trading blind. Because business B, the comparison on your screen, has gone negative, most would assume incorrectly it has no value. Value is found in turnover. If the owners of business B found out that business A was for sale, they would want to buy it because in their hands they could produce more value. The line shown on this graph represents the truth and can be proven. It is the only figure that represents source of goodwill value, full stop. If you concentrate on this line, you will protect your future. Anyone who believes it is based on risk and return and uses lower suspect numbers has simply got it wrong. They use the wrong end of the horse and then use guesswork to find a multiplier and pick a number that best suits the circumstances. So, this is how you value a business. You must be able to compare other sales to obtain a multiplier. You cannot use an industry average based on some manufacturing number. That is the domain of fools. Valuers should only use numbers they can prove and are interpreted from other market transactions. Anytime you read or see the following accounting concepts in a report, such as future maintainable earnings, EBITs, EBITDAs, industry averages, add-backs, vendors' discretionary income, net present values, balance sheet approaches, discounted cash flow, or risk and returns, throw it in the bin or attack it. It is not a valuation, and the High Court was right to throw them out. Unless you can value every asset reliably, you should not be in the game. If you do not know how to value tangible assets, never try intangible assets. The rest of the world runs around looking at net profits, trying to adjust them to make the entity look better. Bless their little hearts. You cannot create value by rearranging expenses, then applying a multiplier that has been guessed or manufactured by someone to suit the circumstances. Every report should contain all the assets shown in the business valuation worksheet because it is factual proof of the values ascribed to each asset type. It is fundamental proof that the valuer or analyst has completed all the tasks and has made determinations of all assets and has confirmed all values in a written format for all to see. It also allows macro understanding of where all values lie. Accounting does not have a future in its present form. You do not need to be a Rhodes Scholar to know that accounting has no future if it cannot keep up with market activity. Value comes from market interaction, not what you spend or adjust. You cannot value a business by adding back expenses. Expenses have nothing to do with the creation of values, but they can impair values and indicate current management decisions which may not be based on market values. In other words, they may buy a desk for $600 when the desk is only worth $400. The world runs around adding back expenses, trying to make businesses more attractive. This is fraudulent conversion via misleading information that is not based on market facts. Highly aligned to graph interpretation is the graphic business valuation worksheet. This can be filled in daily, weekly, monthly, quarterly, half-yearly or annually, and it will also provide clear indications of trading comprehension, such as stock level and control, tangible asset levels, and the decline in values, if any. So if you want to value any business in accurate detail, this is the way to go, because it satisfies the law, it satisfies economic sanity, and it recognises that all values must come from current market information. If you can't see all values in a clear format, you should throw it in the bin. Using the above worksheet is fundamental proof that you have inspected, researched and valued every asset type and recorded your findings in a written graphic format, which is then open to challenge or acceptance. Well, that concludes today's presentation. All of this content can be found at valuationworld.org. Thanks for watching.